Hello traders, it is Wednesday the 31st of January 2018. It's 8:03 a.m. Chicago time. Derivatives trading involves substantial risk of loss. It is not suitable for all investors. Past performance is not necessarily indicative of future results. Looking at the markets this morning, we did get the drift up from the State of the Union. This is fairly steady. My expectation on State of the Union is that we would rise up from the low we put in at 28.22 on the close. Of course, we got lower during the session in the ES at 28.1850. The expectation was for it to drift up to 28.40 and get tangled there in the gap zone and the MC point of control, and the naked point of control, and the gap close from the 25th. So expected the drift up to go on all night. It got the best it could do was 28.39, missing by 4 ticks. Not too bad for a market that's moved 16 points or so to be that close. The market stance across the board is allocation to risk this morning. Gold is higher though. Gold's up $7, trading at $13.47 per ounce, up 52 basis points. The Dow's a leader. Remember, Dow was the biggest. It took the biggest hit yesterday. Dow's a leader, up 208 points in the futures, up 80 basis points. The 10-year note holding sideways. Incidentally, I just want to kind of do a refresher a little bit on the treasuries, the yield curve, and make sure that we're keeping an eye on what's going on macroeconomically with our money here in the U.S. So we'll cover that a little bit today. I'm not going to talk about trading the treasuries, although they have been pretty interesting lately. But I just want to take a look at the big picture. So money has moved out of crude oil. Crude's down 19 cents, which is basically one rotation, one large rotation. 64.31 is the price, and then the dollar's losing value again. Trading at 88 a point to spot 735 in on ice. So that's the roundup. This morning we got ADP employment for January. Came in at 234,000 versus 185,000. Relatively strong. That came out at 7:15 Central, 8:15 Eastern. The market didn't really respond to that much. I watched it, but nothing to do. And then for the rest of the day, what do we have? We have Chicago PMI, which is a mover. However, as I've always warned, Chicago PMI is a private number. It's a subscriber number, so the actual release comes out at about 9:42 Eastern. 9:41, 9:42 to subscribers. We generally see the move if there is one, and then at 9:45 the official public release comes through, and then we generally see it going back to the scene of the crime of the release at 9:41, 9:42. Expecting 64 for January, had 67.8 prior. At 10 o'clock we get pending home sales. For December, expecting 0.5% month on month. And then we get the oil inventories. If you don't have the crude oil inventory release numbers at 10:30, we're expecting a surplus of 800,000 barrels. In crude distillates, a draw of 500,000. And gasoline inventories expecting a surplus of 2 million. Pretty whippy numbers. And then, of course, the biggest release of the day today will be the FOMC rate decision at 2 p.m. Eastern. Expecting it to be between 1.25 and 1.5, in line with prior month, in line with prior month. So that's the rate decision. This is Fed Chairman Yellen's last meeting before she is replaced by Chairman Jeremy Powell. So that's what we have for today. There's quite a bit in the air. As far as trading is concerned, expecting some volatility today following yesterday's sell-off. So let's get into it. Here's what we expected yesterday. Let's go to our review screen. This is what we expected yesterday. Expected a test down, an open auction, a test down, and then the market to climb up to 28.40 and continue to drift upwards towards the prior range. That was the primary plan. Didn't quite work out that way. What we actually got was scenario number 2, a push towards 28.40, and then the market drops down to 28.20 before the bounce. Okay, so a push to the magnet, 28.40, drop to about 28.20, and then a bounce. That's the expected. By the way, I corrected this last night. This prior weekly low was incorrect. It's not 28.25.50, it's 28.09.25, I believe. So this line in the flex levels was moved down. That's an error on my part. I apologize for that. In any case, we're looking for 28.20. Here's what actually happened. So remember, push to 28.40 and then a drop to 28.20. Let's go back and revisit here our friend.
Crude sell 28. Crude sell 20.
See.
Crude buy 20.
That's kind of sluggish.
20 minutes down, 20 minutes U.S. cash equity open.
Here's what we had yesterday. Okay, we open in a gap. The opening print is 28.31.75. The closing print is 28.53.75. A pretty good move, 22 points between the prior day's close and the current open. The market opens in what looks like an open auction. So there it is. It finds the low at 28.29.50, pushes through. A 7-point push. This looks like an open test drive up. So with an open test drive up, we expect the market to consolidate and push higher. It didn't quite give an opportunity, a small pullback, to get long into the 28.40. There's a test 28.39.50. So now we know that we didn't dip down. So scenario 1 gets thrown. We didn't dip down before the push 28.40. So now we're looking for 28.40 to be tested. And it did. And then we're looking for a place to get short into 28.20. That's the secondary plan. That's the secondary trade of the day. So it turns over. We end up with a pretty decent rotation down about 6 points. Tangles into the mid area, and then starts extending the opening swing down. Not sure why my opening swing line is not in here. Starts tangling down, and then again we still have room down to 28.20. There it is. It's not able to find any buyers. We pushed down to 28.18, so we pushed through the 28.20 target, volume profiling target, by 6 ticks, and then we put in a rotation of about 6 points. Pull back to the mid of that rotation, and we hold steady here. Nothing to do, nothing to do, nothing to do. There's a large rotation followed by another large rotation, 6 1/4, 7.75 through the mid. And now we're looking for a grind up, a continuation higher. Note that the IB is 2 standard deviations in range. Okay, historically, it's very unusually wide. We still have the IB stat open. We killed the overnight stat early, and we're waiting for it to pick a side and start heading either to 39.50 or back down to 18.50 for the IB stat. Although the IB stat I use is a gross stat, right? That doesn't take into account the range. Once you break down ranges, it gets a little more complicated. But the problem with breaking it down, to taking it down to a 21 point IB, you end up with too small a sample to have a statistical high confidence. And so I just use it as a gross measure of the fact that we are stuck in the middle, okay? And so as the market pushes forward, it starts to drift down to 28.18. It's below the mid, below VWAP at this point. And so we're looking for a continuation lower. There's a big zipper there during the right after the European close during lunch, and the expectation is it starts to push down and push through 28.1850, and suckers did not do it, and it just basically played in the middle the whole time. What we have is somewhat of a balanced profile. Ending the day. We did not break the overnight stat. This day falls under the 2% side of the historical probability of an IB holding. And then since then, what we've done in the overnight, so this is all part of our review process, what we've done in the overnight is we've built a nice channel, a nice upward channel that keeps zigzagging across, and it's showing a little bit of strength. I expect that we are likely to tangle with 28.40 and then start aiming for the mid of the gap above at 28.4575. That's the gap we left behind yesterday. You should have it on your book map as well as on your IRT. That's where I expect it to be headed this morning. So that's what we've done so far. If we look at the bigger picture, we've basically skipped. See how this weekly, it shows that we opened up right there. We tested up. We traded on Monday. Pretty good rotational day. And then we have this big gap here. And then we skipped through the key balance area from last week. And we traded lower. We do have a fairly balanced profile, but I don't see an excess low. I mean, you could technically say that these single TPOs down here are showing excess, but we didn't see a strong battle. We saw it early in the session, but the market drifted down, back down into that area. So it didn't feel like it didn't seem like it was done yesterday until it started to run up into the close, till this section here. But we have a pretty good taper, pretty healthy looking auction and profile, and we're trading above it today. So this morning the expectation overall is that we're right in the overnight point of control right now. So here we have a large distribution and a secondary distribution down below. We have twice the volume that we expect in the ES, and we are right in the middle of this big area here. Inventory is long in the overnight session, both in delta and in price. The delta long here is pretty high, is relatively high for the overnight session at above 10,000, positive to the buy side. I'm expecting the market to open up and rebalance that. So the first move this morning is expected to be lower, expected to go lower, look for a base, and then start to shift higher. So open auction, I'm expecting the first impulse or the first move, the first serious move, to be downwards, either holding and bouncing at value high or back in line with the point of control of the session, which is at 28.2750. Hold steady, and then we're looking for a reaction impulse up, consolidate, get back into the opening swing, and then start to drift up towards 28.40. Then we get the FOMC at some point, right? Get the FOMC. We're expecting them to hold steady. We're expecting Powell to be quite dovish. And then so eventually we're likely to take out this 28.40. And once we take out the 28.40, shoot, I have to shift this chart up to show you where we're likely to head. But once we take out the 28.40, I'm looking for it to push towards the gap zone mid. Let me get that for you. Gap zone mid at 28.45.50. So I'll just write it on here. The big target post FOMC is 45.50. Okay. That's the big target I'm looking for on the first plan for the day. So as the market drifts down this morning, I'm going to be, now remember what this looks like here because I'm about to switch it. I'm looking for, hang on. So I'm looking for, as the market opens up, I'm looking for it to do one of these opening swings, probably up into 28.36 or so, and then shift down, get into the prior day's value high, get a bounce, likely to push to the point of control right here, and then I expect this to light up nice and bright red down here as we push lower. So as we push lower, we're looking for dark colors turning dark blue to light blue to white to light yellow. This spectrum right here, we expect that spectrum to start showing up, and it's important for the market to be headed in that direction for us to move in this direction of the spectrum until we find the demand or the bids to hold it steady. Look for a long, get long, work risk ahead of the consolidation at value high, the previous day's value high, work scale for risk ahead of the opening swing. And then once it releases, it's likely to grind its way up. Look for a large scale out at 39.50. Your risk should now the theoretical average, which is outlined here in real time. When the trade is on, I expect the theoretical average to drop to below 28.25. 28.18. Yesterday's low, and then you just hold steady for the FOMC with a hard stop, and then look for it to drift to 45 above 45.50. That's the main trade of the day. Okay. Secondary, we don't rebalance. We open. We get a strong push into 28.40. I expect us to butt our heads up against the overnight high into 28.40.41, and then get a response, hold steady, and then be balanced. Go into balance completely until the FOMC comes out, and then I expect it to shoot through to 45.50. That's the expectation for today. If the market follows the same pattern as it's done in the past, this is what I'm looking for. That's the secondary scenario. The third scenario is we push higher, find sellers, get impulsive, push down into the point of control, and are just not able to push up. So that doesn't happen, and we just start to drift lower to continue yesterday's auction. That's an unlikely scenario today, but it's we need to be ready for it. When am I changing my mind about the point of control long idea? It's when it starts to push through the point of control and it starts walking towards value high. I expect it to pull back and then retest that low from yesterday. So why am I doing this on my trigger chart instead of my... This chart's relatively noisy right now. Let's turn that off. Okay. So with this scenario, opens, bids the market up, looking for sellers, finds sellers, impulse down, holds at the point of control, and then slips through. And now we've got a market that is likely to test the prior day's low at 28.1850. So that's scenario number 3. This will result in a loss below the point of control. I expect a loss there when it happens. It is what it is. Then I'm looking for an impulse down, a pullback continuation trade in this scenario to recover from those losses. Losses are just a part of the process. Don't be afraid. Okay, just make them measured. So that's scenario 3. Real quick, I want to talk about the yield curve a little bit. For those of you who may or may not be familiar, it's very important to track what the yield curve is doing. This is the 10-year note. Here's the chart. This is a daily chart of the pit session, or this is the bond. This is the 10-year note, and you can see. So when the future or the price, the spot price of the bond is dropping, yield is going up. The percent interest paid or the yield on that instrument goes higher as the price goes down because the coupon is fixed. And various other measures. And so we end up with, as the futures drop, yields go higher. So the 10-year yield has been climbing since last, I believe, around November 2016. It recovered a little bit, but then it dropped again in August of 2017. It's trending down. So we've made this kind of an inverted head and shoulder. Let me turn that off again. Not an inverted head and shoulder, but a skewed head and shoulder formation here. This is what we have. You have a left shoulder, head, pull back, and then the right shoulder. And so yields are rising. Yields are rising, okay? So this is likely to be a drag on what the economy is doing. I like that yields are rising. I think putting a risk premium on treasuries is a good thing because we've been artificially low for quite some time. This is the bond. The bond is a 30-year product, and so same principle. As the price of the future, the price of the bond drops, the percent on the long end of the curve, the 30-year end of the curve, is rising. So the bonds have recovered a little bit, but over the last month or so, they've been moving lower. And have been having slightly wider range days. This is, oh, no, that's not what I wanted. Where'd it go? This is what I wanted to show you, just as a little bit of a history lesson for those of you who can stick around. I know I'm out of time here, but you look at what we did before 2000, before the crash of 2000. And here's the yield curve. This is the yield curve. So you can see we plot the percent. We plot the percentage rate. Let me change my color. We plot the percentage rate, the percentage yield of every duration for every length of the that treasury note, 3-month, 2-year, 5-year, 7-year, 10-year, 20-year, 30-year bond. We plot where they are, and the normal yield curve, or a yield curve in a market that is in growth, is usually shaped like that. And what happened, this was in 2000, coming into 2000, what happened is eventually the yield curve started to invert. So the short end of the range, which is what the FOMC controls, it controls the whole thing by buying it, but it ends up starting to invert right there in February of 2000. And what I've noticed is it takes about 6 to 8 months for the market to feel the effect. So here's a yield curve that is flat to inverted, and then we get the correction in the S&P. So the right chart here is the S&P, the left chart is the yield curve. Again, during the dot-com, the real estate bubble, we get this yield curve that is climbing. This is the state that we're starting to be in now, currently. And it starts to invert here in 2016 in November. By about the summer of 2006, not 2016, 2006, we get this big drop. And you'll notice that through the drop, the yield curve, look at that, the FOMC starts to aggressively drop the interest rate for the market to recover, and then we end up with a normal yield curve. And this is what the Fed does. This is why these Fed meetings are important. the rate goes down to about 0. And you can see the yield curve is very healthy, and the market starts to rise up. Now here's where we are now. Okay, the long end of the yield curve has been moving lower. Okay, and then the short end is moving higher. So here's what we've got now. Look at that. Oh, okay. So you can see we've been stuck at the low end of this chart, right? And then what you have here through 2017 is that the long end is starting to rise. That's the 10-year and the 30-year dropping, futures dropping. And then the FOMC is pulling up the short end of the curve. And it's starting to look like it is flattening at this moment. So there's a lot of room left for the S&P to continue higher. For those bears, that's not good news. But overall, the market's starting to stabilize, and it's starting to see some of the impact of this large run up. However, just because we dropped yesterday on large volume does not mean it's over. Okay, so don't get into this bear mindset. It takes months and months and months of the market struggling at the top, yields changing, for us to see a true reaction and a new type of market. Good luck.